Hello and welcome to another short mini lecture for your economics course. This particular lecture is going to go over how to calculate out gross domestic product and then in turn use that when determining what the growth rate is from one quarter to the next or 1 year from the next. So whenever we talk about GDP, we're talking about gross domestic product, or what was produced in a given period of time, typically a year or quarter within a country. And it can even be a state that we're looking at, or even a city if we're really looking more specific and granular. Typically, though, we talk about countries when we're talking about GDP. So before we get too far into it and do the calculations on the screen, let me actually just discuss the components or variables within GDP. So the formula for GDP is Y equals C, which is consumption, this first category that you see up there. Consumption on goods and services, and that's any time a consumer buys something. So if I go to Taco Bell and buy food, or if I buy a new car, anytime a consumer buys any type of good, that's consumption. And it's final goods and services only, so you wouldn't include intermediate goods. For example, if you buy a book from a bookstore, that will be included. However, we wouldn't include the paper that one business sold to the publishing company that in turn sold the books to the bookstore, which was bought finally by a student, which is the consumer. We only include book bought by the consumer or the student in this particular example. Only final goods and services are included in the category of consumption. And it's by far the largest component of GDP in developed countries in the United States, as you can see up there. Next, we have investments, so C plus I, which would be investments, and these are anytime businesses spend money on building new factories or equipment, etc., buying equipment that will be used in the production process, but they're not actually going to be resold in some manner. They're used to produce more goods and services, but they're not actually going to be made into goods and services. And lastly, you have government in terms of the positive side, I should say, for GDP. So government expenditures are anytime the government spends on goods and services. And for example, this is positive if the government spends money on building a road or construction of a school, education spends money in terms of healthcare. All of that's going to be government spending. Now, you might be thinking, why is that positive if we're paying tax dollars for those particular goods? That seems like it might be a negative, especially in the United States where we don't have a surplus. We'll talk more about government budgets later on, how they're impacted. But when you think about it, if we're going to spend more money on government spending, let's say military, and we just keep increase, or education, you name it, infrastructure, eventually we have to raise taxes. And as we raise taxes, consumption in turn will go down. So it can't constantly be positive and always having a positive impact on GDP without eventually having a negative impact on consumption as real income. So that's why it's positive. At some point, we have to pay for things, and so there is that correlation there. Now, when there's a downturn in the economy, you're probably going to see government spending go up because you're trying to stimulate that economy, right? Economists would say that we'd like for government spending to be in check, and therefore when you have surpluses, try to limit the amount of spending. Don't overdo it. And in times of expansionary phases where you need to grow that economy because you've had a contraction, then you're going to see a ramp up in government spending. All right, so Y equals C plus I plus G plus NX. So this is your net exports, and this is its own equation, which is exports minus imports. So you just take all the things that are produced domestically and sold abroad minus the goods and services that are bought from other countries. Now, it could be positive theoretically. In most developed countries, it's a negative. That's not a bad thing. This is where you get the trade surplus or trade deficit. A trade surplus is anytime this is positive. So I'm going to write that right here. Trade surplus, a positive number, and a trade deficit, this is a negative number. All right, I'm going to erase this. Just highlight equation down here, though, on your screen, so that way, as we go through these problems, you can refer back to it. So Y equals C plus I plus G plus NX, or GDP equals C plus I plus G plus NX. And you understand exports minus imports. The reason why exports minus imports having a negative number here or a trade deficit doesn't necessarily mean a bad thing for the economy is if you think about it in the United States, we buy a lot of cheap goods from other countries where they have a comparative advantage, and we are able then to produce and buy our expensive goods, and so consumption actually goes up because we're able to buy cheap things from other countries. If we only bought from the United States, that consumption number would actually go down even though our net exports is slightly increased. Because then in turn what happens is you're buying expensive things like an iPhone that's 100% produced in the United States, that's like 10 grand. And if you pay 10 grand on an iPhone, then you're not able to consume on a lot of different things. And that really inhibits your innovation, your consumption, etc. We'll learn more about that in future chapters. But this is the equation for GDP. So let's go ahead and do this calculations on your screen real quickly. So GDP, y equals c plus I plus g plus nx. I know I said that really quickly, but y equals c plus I plus g plus nx. Get that in your head so that way on the exam you can quickly do it. You just sub in those variables. So calculate the U.S. is real GDP. And remember, real just means we adjust for inflation. For the following and lists whether there was a trade deficit or a trade surplus. For quarter one of 2020, GDP, it could be y equals also. So my first variable is consumption, C, 3,636 billion, plus my government expenditures, 950, and then minus my net exports. So we have, or I should say, plus my net exports, plus my exports, which would be line, plus my exports, 609 billion, minus 33. And when you calculate out that number, so 609 minus 733, I'm going to do that first, my net X. You would have a negative 4 billion. So that's where that you would subtract that out. You calculate it, you're going to get a negative number there. We have a trade deficit. Getting a little bit ahead of myself. Question though. So you just add these in. It's simple addition, subtraction, and handwriting, but you end up with 5,012 billion minus 124 for that first quarter, 5,000. So that was the GDP in quarter one, 2020. Now the question asks, is it a trade surplus or a trade deficit? This particular example, it's a trade deficit. How do I know that? Because here, all right, so the second quarter, same thing. We're still talking about 2020 on the screen. Actually, it's not very good in class either. You just sub in, so I've got my variables right here, 4 billion, 2 billion, 9 billion, plus 447, it's 580. You add them all up together and subtract, you end up with 4,000, and that's my second quarter, 2020 for the United States. And was it a trade deficit or a trade surplus? It's also a trade deficit. And how do I know that? Well, this right here would end up. Okay, lastly, we need to calculate out growth rate, GDP growth rate for the second quarter of 2020. Well, how do we do that? Well, here's why we add up all these specific categories, is we're able to determine what's going on in the economy and where we're getting the biggest hit or growth, depending on what's happening. And I like to talk about GDP in terms of the blood pressure of the economy. Anytime someone says the economy grew or shrank, this is what they're talking about. I'm going to zoom in, erase some of this so you can kind of see this last question. All right. What we need, though, is our GDP growth rate formula. So growth rates formula for GDP equals GDP2, so our most current GDP, minus GDP1 divided by times 100%. So what we're looking at is what was the rate of growth from one quarter to the next. And all you have to do is just sub in your GDPs above. So in the second quarter of this particular year, now it's not always going to be GDP2 if we were comparing the growth rate from, or I should say quarter four of 2019 to quarter one of 2020, we're going to have GDP2 equal GDP1 quarter, right? The first quarter. but it would be the first quarter compared to the previous year's last quarter. It just depends on what the most recent is. If we're looking at the very last quarter, so quarter 4 GDP growth rate, it would be quarter 4 minus quarter 3 divided by quarter 3. But because this is nice and easy, we're going to leave second quarter we're calculating. So you just sub in there, your GDP2 is that second quarter of 2020. So 4,879 minus our quarter 1, the most recent previous one, 5,388 divided by 8 times 100%. And you would have, in this particular example, do my math real quickly, I got a 509, and I ended up with, if you do that math, a negative 9 point, roughly 4%. So negative 9.4%. That's our growth rate. In other words, the economy contracted by a negative 9, or contracted by 9.4%, almost 10% decline in growth from quarter 1 to quarter 2. Well, why did that happen? Well, if I just zoom back over to the variables, it's pretty easy to see. Consumption went down by almost $400 billion. That's a significant amount. Well, why did it? Well, because of the government shutdowns, plus the pandemic itself, people weren't consuming, especially the older people who were not going to go out and spend money because they were worried about their health. They were most at risk. And what you have is unemployment increasing, and as unemployment increases, people don't have jobs, they spend less money. For whatever reason, there were a lot of factors in the pandemic itself at the first that you saw this decline in growth. Now, what's interesting is if you were to actually calculate out the GDP growth rate from quarter 2 to quarter 3, you would see a pretty significant rate of growth. In fact, it would be about 8.3%. What is intriguing, actually this one was a negative, I believe almost 1%. And what happened was at the last of quarter 1, you had March and people were starting to not spend as much because of that, plus oil collapse, etc. Is you have a recession right here, and then immediately, because the recession is 2 back-to-back quarters of negative growth, we immediately came out of the recession. The first time in history that we've had just a recession last that short period of a time. But what's kind of intriguing, if you look at it, yes, there's this growth of 8.3%. However, quarter 3, remember these are adjusted for inflation and seasonal changes, is actually less than quarter 1. So even though we had that significant growth, we still weren't back to where we were pre-pandemic. And in fact, we still aren't quite back to where we were previously in 2019. Well, this was just a short, quick analysis of GDP, how to calculate it out, how to utilize it, determine various things. If we were to go in deeper, we could actually see that the consumption expenditures, the big category within that subcategory, I guess you could say durable goods is the one that people really didn't spend as much on during the pandemic. Those are things like cars, major electronics, etc., houses, homes. And what we've seen is since we've been able to open back up, since we've had a vaccination where more people feel comfortable spending money, consumption has gone up, people are willing to spend more on these durable goods and services. And once you do that, you're going to really need a lot, right? A high demand, a pent-up demand essentially is built up there. And so that supply needs to quickly increase. It's been difficult to increase that supply quickly. And so that's where we have this excess supply. And that's a problem with cars and why used cars have gotten so expensive. All right, if you have any questions, please contact me. I know this is kind of fast, but I want to make sure it's thorough enough that you understand it, but quick enough that you pay attention. And as always, go Broncos.